Overnight at a conference organised by the European Central Bank in Portugal, the chairman of the US Federal Reserve made a point that he will do whatever it takes to crush inflation. And that includes the risk of pushing the US economy into recession. So here's a key part of what he had to say.
We're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive. And as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening, and we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
It's a big call, but here in Australia, there's none of that, not yet at least anyway. After retail sales reported their fifth straight record month yesterday, today bank regulator APRA reported the biggest lift in business credit in more than 13 years, and housing credit as well keeps on growing. Then the Bureau of Statistics said that job vacancies jumped 13.8% in the past 3 months to record levels. Now, these are boom time numbers, not the stuff of recession. So let's bring in here Paul Bloxham, Chief Economist with HSBC Australia and also a former economist with the Reserve Bank. Paul, always good to have you on the program. Let's go to this. Australia is either lagging the rest of the world or was somehow different. Which is it?
Well, I think it could be a little bit of both. I mean, I think part of the story here is you're right. You're spot on that growth is really strong here at the moment. There's a lot of momentum in the labour market. There's a lot of momentum across the economy. But that is part of the challenge. We've got a lot of momentum in an economy. We've got strong demand in an economy where we are hitting all of our supply constraints. The unemployment rate's at its lowest level since the mid-1970s. As you say, job vacancies are at an all-time high, an extraordinary high in the scheme of things. That's telling us that the economy is operating at least its capacity, if not a little bit beyond. And really, there are two answers to this. One is sort out the supply side, get more workers and get more things into the economy, or slow down demand. And really, I suspect what's going to happen is the RBA is going to keep lifting interest rates until it's slowed demand sufficiently that gets inflation heading back to target. Inflation's already running at over 5%.
OK, it's already over 5%. And the fact of the matter is you've got teachers in the streets today protesting, right, that they want more money. You've got nurses wanting more money. Police want more money. So civil servants want more money. The private sector, when enterprise bargaining agreements come up, want more money. So there's a push on to keep up with the cost of living by demanding more. And so all of these things just add to the inflation story. None of this that you and I are talking about is taking away from inflation. It's only adding to inflation and the prospect of higher interest rates.
That's right. And I guess the challenge here is the RBA is going to lift interest rates to slow down the economy, to slow down demand. And when we think about it, that's really all they've got left. I mean, they can only slow things down from here. So we have to have some sort of an economic slowdown in order to get the inflation out of the system. The key question, and the one they're grappling with in the US at the moment, of course, is do you have to slow it down so much that you actually end up delivering a recession in order to get the inflation out of the system? And I think there you can draw a bit of distinction between Australia and other countries across the world. You are seeing some signs that it's getting into inflation expectations in other places, particularly places like the US where that's happening to a degree, and in New Zealand as well. It's very clearly there. And I think in those places, they're going to have to deliver quite a slowdown in economic growth. And in New Zealand, for example, we've got in mind they deliver a recession in order to get the inflation out of the system. But here, it's not yet in inflation expectation. You're describing all the characteristics of it possibly getting there. That is that unions are demanding higher wages and all the workers and so on. But if we let it get in there and we let it pick up in terms of getting into the wage setting process, then the RBA will have to lift interest rates more, slow the economy more. And that is why the governor is describing what we've got as sort of a narrow pathway. We want to slow growth just enough to get inflation to head back to target, to pull the economy just a bit back from operating at full capacity. But if things get get going too much and inflation gets embedded in the economy, then we'll have to actually slow things down a whole bunch more.
So there's one thing I think that Australia could potentially do, and that is rapidly increase migration. So right now, the inbound tourism is 20% of its pre-pandemic level. You start to accelerate the number of people coming to this country. You take away the labour shortages that we have. You take away much of the wages pressure that's currently there. And maybe you do get the soft landing with lots of people remaining in their jobs. Is that nirvana?
Well, absolutely. Look, so if we think about it in that framework, demand is running really strong and we're up against our supply capacity, if not a bit beyond it. So two options, either slow the demand down or fix the supply side problems. Right? And so one of the key supply side problems we have at the moment is a lack of availability of labour. It's evident, right, in the extraordinarily level of job vacancies, the very low unemployment rate. So one solution to this, of course, is to speed up the amount of workers that can come in from offshore. We've reopened the border, but we've got to speed up the visa process. That would be very helpful. Attract workers from offshore. Challenge is, of course, that's not that easy to do, firstly. Secondly, the rest of the world's looking for workers as well. Their labour markets are all tight, super tight too. So that presents a bit of a challenge. But you open up a bigger basket of things as well, which is what we ought to be focused on is supply side policy. And, to an economist out there, economists have been saying this for years. It's not something brand new. We need to look at competition policy. We need to look at industrial relations. We need to look at the tax system. We need to do supply side reform. We need to fix up the supply side. In the short run, though, I think in the end, it's going to be a slowdown in demand that gets inflation heading back to target.
I'll tell you what, Paul, it's always great to have you on the program and good to talk to you about this today. We'll come back and do it again very shortly. Paul Bloxham, Chief Economist of HSBC in Australia.
Cheers.
Thanks so much.